Hey guys, it's Willie, and today I want to take a look at Microsoft. Microsoft is an amazing company. It is either the number one or number two largest company by market cap in the world. It seems to depend on the day. It seems to go back and forth between Microsoft and Apple. But today I want to take a look at Microsoft. Over the past 6 months, they're up 7.4%. Over the past year, they're up 27%. So if you've been in it, you've had a fun ride. And if we look at the max chart, you can just see right here, it just hockey sticks, goes practically straight up as a stock is going to go anyway, over such a long period of time. It's a wonderful company, but today I want to take a look at some numbers in our spreadsheet to see if we think Microsoft could be a good value play from its current price of $310. Is it? Is it not? Let's jump into the spreadsheet and see what we think. Alright, so now that we're in our spreadsheet, I want to first start with our revenue, our earnings, and our cash flow from operations. So these are basically the money that the company brings in. Think of this as your sales, how much you get in sales. This is how much is in profit. Cash flow from operations is very similar to that. These are the ways that the company is making their money. So as we can see, it's pretty similar. You're seeing growth. Revenue went from 73 to 168. Earnings went from 17 to 61. Cash flow from operations went from 32 to 76, almost 77. So you're seeing growth rates, 9%. Earnings is growing at almost 14%. That's fantastic. On to CapEx. These are our day-to-day expenses to keep the company running. It went from, that would be $2 billion to $20 billion, which it's growing at 24.5%, but considering that they're making so much in earnings and really so much in revenue on so little expenses, that's because they're a software company, it's a really good thing that they have low expenses relative to the money that they're making. Fantastic, looking good so far. Free cash flow, this is what a lot of investors are really interested in because that's really where we derive a lot of the value that we get out of owning our shares. It went from $29 billion to $56 billion. That's 6.7% growth over the past 10 years. Shares, here's another place where we get a lot of value. You're seeing $8.5 billion down to $7.6 billion. That's a decrease of about 1% per year over the last 10 years. This is great. This is increasing our share, our portion of the company that we own. Here we split it up. We split the earnings and we split the free cash flow into a per share number. So we've seen earnings grow from $2 to $8 a share. We've seen free cash flow grow from 3.5 to 7.5-ish per share. You're seeing earnings per share is growing at a really quick rate of 15%. That's because they're growing earnings really quickly back here, but it's also because they're decreasing their shares. Free cash flow, same story, 8%. They're growing free cash flow and they're reducing the shares. It's growing quickly. Now on to debt. It went from $55 billion to $192 billion. One would think that $192 billion in debt was a lot. However, Microsoft, it doesn't really matter to them because after that $192 billion in debt, they've got $130 billion in cash. So after they pay it, you're getting a net debt of only $61 billion, which for Microsoft, that's basically 1 year of earnings, a little bit over 1 year of free cash flow. That is a really safe company. They're not going under anytime soon. I mean, obviously not because their products are good, but also the debt is very, 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 very reasonable. No problem for them to handle. As a matter of fact, we saw a couple years back here where they had more cash than they had total liabilities. Again, these are total liabilities. This is everything. This is all the debt. Short term, long term, everything. So your net debt is growing. But again, it's under a very controllable level because of the free cash flow and earnings that the company generates. Return on invested capital, it's growing, it's good, it's really high. This is Microsoft doing a really good job taking its money and investing it in whatever way they see fit. They just bought Activision Blizzard not long ago. What was that, a week or two ago? I don't know. But they just bought them out. These are the kind of operations that they're doing to drive the return that they're getting on their capital. Now over to our metrics. I want to point out all of these red ones here up the top. These are our PEs and our price to free cash flows. These indicate that the stock is overvalued since these are really high. But however, our other metrics are good. So our net debt, good. It's good. Our revenue growth, earnings growth, free cash flow growth, positive, double-digit positive, which is even better. Shares outstanding is going down. 5-year return on invested capital, really good, 28%. So let's switch over now to our forecasting to see what we think we can do if we were to buy the stock today. I'm assuming a 5% growth rate of the free cash flow, a 15 multiple price to free cash flow. That gives us a stock price of $180 in 2030. I'm also assuming a 5% growth rate for earnings every year. Again, I assign a PE of 15. That gets us $197 in 2030. Now, the reason I pick these numbers, when you look back up here, earnings has been growing at 13.5%. Free cash flow, on the other hand, has been growing at 6.5%. But that's still bigger than your 5. So really, I want to make a conservative assumption. So free cash flow, I haircut it a little bit to get the 5. The earnings, however, I looked at it in a different way. You've seen a big spike up here. I think that's a lot to do with COVID. I would expect the earnings to kind of start to come back down, or level off. I would say level off rather than come down. But plus earnings and free cash flow should grow in line with each other. As far as the multiples, this is a really big company. Basically, the majority of the market at this point is, in the top 10 companies in the S&P 500. So I just took the market average of 15 to get those. Now, here, the stock is currently $310. Here's our two prices. We average those together to get $188.50. We go to our IRR. You're in at 310. You get these cash flows as you own the stock, and you're out at 188. Guys, you're not even breaking even. I hate to break it to you, but this looks terrible, especially if you believe these numbers. This looks really bad. You're not even breaking even. You're losing money over the next 10 years investing in Microsoft. So the question becomes, why? Microsoft is a fantastic company. I'm not going to argue that point. It is a fantastic company. It's wonderful. It's growing really quickly. It's doing responsible things. It's buying back its shares. It's investing its money. It's doing wonderful things. The problem is this $310 price. Again, our metrics up here were telling us, PE, too high. Price to free cash flow, too high. Way too high. So it's this price. So if I'm looking to buy the company, what price am I looking at? Well, if I punch in $150 and get that, I'm getting about a market return. So really this company has got to fall in half. I know that seems like a lot, but this is just the math, guys. I hate to say it, I'd hate to see Microsoft fall in half. It's a wonderful company, but I think the price is just too high. Let's switch it back to our 310. So let's say you think, well, I'm going to buy it anyway. I'm going to buy it at 310 because I think it's going to grow faster. Okay, let's switch over here and let's type in 15%, which is something a small company would be happy to do. A fast-growing small company, not a behemoth like Microsoft. I do not think in any way these numbers are possible, but I just want to illustrate that you're looking at 15% per year to just match the market. Just to match the market, guys. And you're looking at 20% if you're expecting to beat the market. I just think it's too expensive right now. I hate it. I wanted to talk about it because it's such a popular company. It's such a wonderful company, but the price is just too high. Right now, I'm just going to hold off until I'm looking more toward the 150 stock price. So it's just, I don't hate the stock. I just hate the price of the stock. It's a great company. I'd be buying it otherwise. So with that said, as always, do your own due diligence. Do your own research. Don't listen to some guy on YouTube. Do your own thing. Do your own math. Use your own numbers. Don't listen to me. I mean, I prefer you listen to me because I'd like for you to watch my videos. But again, don't just go out and buy it because somebody on YouTube did some math and said it was good. Do your own research. Do your own due diligence. And as always, like, comment, subscribe, all that good stuff. You guys know the drill. And with that said, I will see you guys in the next video.